Smart Money Part 2. Hello friends, welcome to the Smart Money Trading channel. The goal of this instructional video is to familiarize ourselves with the terminology of smart money trading and to use trading methods related to this style, navigating the waves of smart money in our trades, preventing potential losses through risk management and capital preservation, and benefiting from the profits of this type of trading. To start off, it's best to become acquainted with the definitions, concepts, and amendments related to smart money. What is smart money? Smart money refers to institutional investors, investment funds, banks, and other large companies with significant resources and expertise. Understanding the actions of smart money is crucial for retail traders, as these players often shape market trends and can provide valuable insights into future price movements. Some key terms in smart money trading include 1. Liquidity, the collection of stop losses and pending buy or sell orders. 2. Mitigation, refers to a point where smart money enters a losing position and brings it to the break-even stage, meaning it takes the market to a point where it exits without profit or loss, especially for positions incurring losses. 3. Break of structure, BOS indicates the strength or weakness of a trend in the market. 4. Change of character, CHOC indicates a change in the order flow, suggesting potential changes in market trends where many order blocks exist. 5. Fair value gap, FVG. The gap in fair value signifies an imbalance in price created by large orders. In this section, we will first examine the break of structure on the chart. Understanding market structure is essential for analyzing charts, as market structure provides us with crucial information about market trends. Generally, we have three types of structures in the market. 1. Uptrend. 2. Downtrend. 3. Ranging market. Trend types. Uptrend. In an uptrend, prices generally move upwards over time. And this trend is characterized by higher highs and higher lows. Each low formed in this trend is higher than the previous low, indicating the market's inclination towards bullishness. Downtrend. Conversely, in a downtrend, we have lower lows and lower highs in the market. Each high formed in the downtrend is lower than the previous high, indicating the market's inclination towards bearishness. Ranging market. The third market state, range or neutral, where new highs and lows are not formed, and prices oscillate within a certain range, indicating decision-making among buyers and sellers. Break of structure plays a significant role in determining the strength or weakness of buyers and sellers. Break of structure is used to describe a significant price movement that surpasses support and resistance levels in the current trend. In an uptrend, when we see the formation of higher highs and higher lows, we should mark the last swing high, and if this swing high is broken upwards by several strong candles, we have identified a break of structure. In a downtrend, when we observe the presence of lower lows and lower highs in the market, we should mark the recent swing low on the chart, and if in the next step we see several strong bearish candles in succession towards the downside, indicating a sudden downward move, then we have identified a break of structure in the market. On the other hand, change of character, CHOC, indicates a potential reversal in the market after recent swing high or swing low breaches. CHOC describes a significant change in market price action. For example, consider a market in a downtrend where we had lower lows and lower highs. When these recent swing lows are broken by price, a CHOC or change in character occurs, indicating a potential change in the downtrend. This suggests that buyers have taken control of the market, and if the price continues to form new higher highs and higher lows, then we are in a reliable uptrend. The trend has transformed into an uptrend, and we should look for break of structure patterns on the chart, i.e., previous swings and new formations. Example: in this example, the market was previously in an uptrend, meaning we witnessed higher highs and higher lows in the market. In the next step, we can clearly observe a break of structure in the market, but as we continue to observe, we see that the previous low is broken downwards by the price, forming a swing low on the chart, indicating the creation of a CHOC. This implies a potential change in the market trend from uptrend to downtrend. Note, in summary, break of structure indicates the continuation of the market trend, while chalk signifies a reversal and change in the market trend. Fair value gap (FVG) analysis. Moving on to the examination of FVG on the chart, FVG is used to detect inefficiency or imbalance in the market, fair value gap. This imbalance occurs in the market when there is significant buying or selling pressure, resulting in a major uptrend or downtrend in the market. Now, let's examine the concept of fair value gap, FVG, on the chart. In most cases, when we observe consecutive candles on the chart, the price tends to return, and we see shadows on both sides of the candles. However, in special cases, when we see candles without overlapping shadows on both sides, we have a fair value gap, FVG, in the market. The idea behind FVG is that eventually, the market returns to these areas where FVG exists and shows a reaction before making a significant move in the same direction. If you are familiar with supply and demand trading, you know that this is the same principle as supply and demand. When we identify a supply zone in the market, it is likely that the price will return to these supply zones in the future. Therefore, we can use FVG to identify entry and exit points in the market. To create FVG, there must be a cluster of 3 candles indicating heavy buying or selling in one direction of the market. Example 1, as we can see here, when there is a significant movement in both directions, there is a gap between the shadows of the first candle and the last candle, indicating a demand, and the market returns to this demand. Example 2, in this example, there is no FVG on the chart because the shadow of the last candle overlaps the shadow of the first candle. If you have difficulty in identifying FVG, you can use indicators available in TradingView. Order block, OB, concept analysis. We have 2 types of order blocks. 1, bullish order block. 2, bearish order block. Bullish order block. In a bullish order block, we find the last red bearish candle before a significant upward move, and we draw it as a zone. Bearish order block. In a bearish order block, we identify the last green bullish candle before a significant downward move and draw it as a zone, then we wait for the price to return to this zone. However, not all order blocks should be identified everywhere, and not all order blocks are reliable. To identify the correct order blocks, we need to consider a few points. Bearish order blocks are formed when the market changes from an uptrend to a downtrend. Bullish order blocks are formed when the market changes from a downtrend to an uptrend. The method of drawing order blocks varies depending on the type of candle. If the candle is a strong bullish candle, we draw the entire body as the order block zone. When a candle has a small body, both the body and the candle's shadows are considered as the order block zone. An important point to note is that order blocks represent supply and demand zones. They indicate areas of accumulation with high volume before a significant market move. These areas are highly probable zones that can be used for excellent market entries and exits. Friends, if you like watching this educational video, come support me and give me energy by liking and subscribing as well as your comments. Liquidity. Understanding liquidity is a fundamental concept in smart money trading. Liquidity acts as a magnet for price as it is constantly looking for a place to trade and accumulate positions. Liquidity primarily refers to the presence of orders at various price levels, and these orders influence price movement and often lead to market violations and lows, causing losses to retail traders. The question here is, where does liquidity form in the market? We can identify old highs and lows as liquidity points, and also consider equal highs and lows, meaning highs and lows that occur in the same direction, as liquidity. Liquidity can be found along trend lines in chart patterns at support and resistance levels. In essence, liquidity refers to pending orders placed above and below support and resistance levels. So, to simplify this concept, we consider a trading range. Below this support level, we can expect to find stop loss or stop orders placed by buyers, and above this resistance level, there will be stop loss orders placed by sellers. If the market reaches below the support level, sell transactions are initiated, while if the price breaks above the resistance level, buy transactions become active. In this context, liquidity refers to the collection of orders on both sides, and for large institutions, opening large orders in the market is necessary to reach these liquidity points. If retail traders are stopped out due to small price movements, it is because we provide liquidity for large market players. In other words, these large market players work in a way that traps small retail traders and triggers their stop losses. In the upcoming sessions, we will definitely discuss how to escape from these traps so that viewers of this video can avoid losses as much as possible. Thank you for watching this video. If you have any comments or suggestions, I am eager to hear them. Please send them to me in the comments. Also, support me by liking and subscribing, and give me more energy to continue these tutorials.